Hey everyone, and welcome back for another deep dive. Today, we're going to be looking at something that I think is particularly interesting,
Okay.
and that is the potential of Chinese stocks.
And, this is something that I think is really important for anybody who
Yeah.
is either interested in diversifying their portfolio internationally or just interested in understanding how global events can shape investment decisions.
Absolutely. I think that's a great choice for today because it really underscores this idea that's so crucial in today's investment landscape. And that is just how globally interconnected everything really is.
Yeah, and the article kind of starts out with this pretty dramatic example. South Korea declares martial law,
Uh,
and then all of a sudden U.S. oil prices jump a couple of bucks. Like, what's the connection there? Right. Well, it
Yeah.
just shows just how sensitive markets are to any kind of geopolitical event, even ones that might seem unrelated at first glance. Remember, oil is a global commodity, so anything that even hints at potential disruptions to supply chains,
Yeah.
like you have martial law in a key manufacturing hub, that's going to make traders nervous, and it's going to push those prices up.
So even if I'm not directly invested in like South Korean companies or oil futures or something like that,
Right.
this event can still ripple out and affect my portfolio.
Exactly. It underscores why a global perspective is so essential for investors today. You can't just focus on what's happening in your own domestic market anymore.
Okay, so we've kind of established that, the world is a pretty tightly woven tapestry when it comes to finance. The article then takes us into this realm of something that I've always found a bit mysterious, and that is bond yields.
Oh, yeah.
Could you demystify those a little bit for us?
I think about bond yields kind of as a country's financial heartbeat. It's the return an investor can expect for lending money to a government or a corporation by buying their bonds. And here's where it gets interesting. The faster that heartbeat, the more risk the market perceives.
So a high bond yield is like a racing pulse, kind of a sign that something might be a little bit amiss.
Precisely. The article gives a good example of this. You look at Brazilian 10-year bonds, they're paying over 13%.
Wow.
Compare that to U.S. 10-year bonds, much lower at 4.2%. So investors are demanding a much higher return on those Brazilian bonds because they see more risk associated with lending to Brazil compared to the U.S.
That makes a lot of sense. But how does this all relate to the question of Chinese stocks?
Well, that's where we get into some really interesting dynamics between China and Japan.
Cool.
Now, typically, you'd expect a more developed economy like Japan to have lower bond yields than a rapidly growing, perhaps more volatile economy like China. But we're actually seeing an inversion.
An inversion, like the world is upside down.
Well, in a way, yeah. Japanese 30-year bond rates are actually trending higher, while Chinese rates are declining. Now, the article suggests this could signal a shift in market perception, a growing belief that maybe China is becoming a less risky bet than previously thought.
So this unusual bond activity could be like an early indicator that something bigger is brewing in the market. That's pretty intriguing.
It certainly is, and this brings us to the heart of the article's argument. Is this shift in bond yields pointing towards a buying opportunity for Chinese stocks?
And there are three specific companies that the article highlights that we should keep our eye on, right? Alibaba PDD Holdings and the iShares MSCI China ETF. What's the rationale there?
Well, the article points to this fascinating observation. They say that the CSI 300 index, which is essentially China's version of the S&P 500, is currently yielding double the rate of Chinese 10-year bonds.
Hold on, stocks yielding higher than bonds. Isn't that unusual?
It is. Under normal circumstances, stocks shouldn't yield more than a country's bonds because bonds are considered less risky than stocks, so they typically offer a lower return.
So if stocks are yielding more than bonds, that suggests that something might be a little bit out of whack.
You got it. Historically, there have only been 2 times in the U.S. where the S&P 500 yielded higher than 10-year Treasury bonds.
Okay.
2008 and 2020.
Periods of extreme market stress. So are we seeing a similar situation unfolding in China where fear and uncertainty are pushing stock yields higher?
That's a key question the article raises. Could it be that Chinese stocks are actually undervalued right now due to this heightened sense of fear rather than their actual performance?
If that's the case, wouldn't that mean it's a great time to buy? Like that classic Warren Buffett advice, be fearful when others are greedy.
Right.
And greedy when others are fearful.
And that's exactly the line of thinking that some of the biggest names in investing seem to be following right now.
Oh, wow. Okay, well, if it's good enough for them. But before we jump into who those big names are, let's take a quick pause. I want to make sure you, our listener, have a moment to digest all this before we get into the specific stock picks. It's a lot to take in. But it's pretty exciting stuff, right?
It really is. These signals from the bond market suggest that something's shifting in the way investors are viewing China, and where there's a shift in perception, there's often opportunity.
Okay, so you mentioned that some big names in the investing world are taking notice of this.
Yeah.
Spill the tea. Who are these investing titans making moves in China?
All right, we're talking about the likes of David Tepper, Michael Burry, Howard Marks. These are folks who've made a career out of spotting market inefficiencies and capitalizing on them.
Wow, those are some legendary investors. And they're all buying into Chinese companies.
Yeah.
What are they seeing that maybe the rest of us are missing?
Well, the article specifically mentions that they've been snapping up shares of Alibaba and PDD Holdings. These are companies with strong fundamentals operating in a rapidly growing market.
So these investors are essentially putting their money where their mouth is. They're betting that this current fear surrounding China is overblown.
Right.
And that these companies are poised for a rebound.
That's a very astute observation. Their actions speak volumes. They're clearly not letting the headlines dictate their investment strategy. Instead, they're digging deeper. They're looking at the long-term potential of these companies.
It's like they're saying, hey, everyone's running for the hills. But we see a golden opportunity here. But I have to play devil's advocate for a moment. Isn't investing in China inherently risky?
There's always risk in any investment. But you're right, international markets, especially those in emerging economies, often come with additional layers of complexity.
Like what?
Well, for starters, the regulatory landscape in China is very different from what we're used to in the U.S. The government has a much more hands-on approach, and regulatory changes can happen quickly and sometimes unexpectedly.
Right. I've heard these stories about how the Chinese government can just kind of suddenly change the rules of the game for certain industries, which can obviously impact a company's profitability.
Exactly. So understanding the specific regulatory risks associated with any Chinese company you're considering investing in is absolutely crucial. It's not just about looking at their financials. You have to understand the political and regulatory context in which they operate.
And it's not just about domestic policies either, right? There's also this whole geopolitical situation to consider.
Absolutely.
China's relationship with the U.S. And other countries can be a bit, shall we say, volatile.
Geopolitical tensions like trade disputes or political disagreements can introduce a lot of uncertainty into the market. And that uncertainty can translate into price volatility, which can be nerve-wracking for investors.
So it's like trying to solve a Rubik's Cube while riding a roller coaster.
Yeah, that's a pretty apt analogy. It highlights why thorough research is paramount when investing in China. You need to go beyond the headlines. Delve into the specifics of each company, their business model, their competitive landscape, and their long-term growth prospects.
Okay, so we've established that investing in China requires a bit more due diligence than, say, picking a stock from the S&P 500.
Yeah.
Let's talk about these specific stocks. The article seemed particularly bullish on Alibaba, even mentioning a potential 53% upside. What's fueling that optimism?
Well, Alibaba's dominance in the Chinese e-commerce market is a major factor. They're often compared to Amazon. But they actually have an even broader reach with this vast online marketplace, a robust cloud computing division, a digital payment platform, and even a foray into entertainment.
Wow, they really do have their fingers in a lot of pies.
They do, and that diversification is seen as a strength. It allows them to tap into multiple growth avenues within the Chinese economy. Plus, their cloud computing business, Alibaba Cloud, is a major player in the global cloud market, competing directly with Amazon Web Services and Microsoft Azure.
So even if one segment of their business faces some headwinds, they have other engines to drive growth.
Right.
That's reassuring. What about PDD Holdings? The article mentioned Macquarie projecting a potential 130% upside. That's pretty mind-blowing.
It is. PDD Holdings is known for its innovative social commerce platform, Pinduoduo. It leverages social networks to drive sales, offering deeply discounted products through group buying and interactive shopping experiences.
So they're kind of like a hybrid of Groupon and Facebook, but for shopping.
You could say that. They've been incredibly successful at attracting a massive user base, particularly in China's lower-tier cities, by offering incredibly competitive prices and gamifying the shopping experience.
It sounds like they've really tapped into the pulse of the Chinese consumer.
They have, and that's why some analysts believe they have tremendous growth potential.
Okay, so we've got Alibaba, the e-commerce behemoth with its fingers in multiple pies, and we've got PDD Holdings, their social commerce disruptor, with its finger on the pulse of the Chinese consumer. Now, for those of us who are maybe a little bit hesitant to put all our eggs in one basket, especially in a market as dynamic as China's, what are our options?
That's a very valid point. Diversification is always a prudent strategy, especially when investing in international markets. And that's where the iShares MSCI China ETF, or MCHI, comes into play.
Oh, yes, the ETF route. Tell us more about that.
Well, the MCHI ETF allows you to invest in a diversified basket of Chinese companies,
Okay.
reducing your exposure to any single company's performance. It tracks the MSCI China Index, which includes a broad range of large and mid-cap Chinese companies across various sectors.
So it's like a one-stop shop for investors who want to dip their toes in the Chinese market without having to pick and choose individual stocks.
Exactly. It provides a convenient way to gain broad exposure to the Chinese market while spreading your risk.
But of course, as with any investment, it's essential to do your homework. Understand the ETF's underlying holdings, its expense ratio, and its overall investment strategy to make sure that it aligns with your own goals.
Couldn't agree more. Informed decision-making is key in any investment scenario.
Well, we've covered a lot of ground today.
Yeah.
From the interconnectedness of global markets and the cryptic signals of bond yields to the potential upsides and inherent risks of investing in China. It's been a fascinating exploration.
It has, and I think it highlights the importance of staying curious, informed, and adaptable as investors in today's ever-changing world.
Before we wrap up this deep dive, I want to give you, our listener, a moment to reflect on everything we've discussed. Investing is ultimately a personal journey. What resonates with you? What piques your curiosity? I mean, it's a lot to consider, right? The allure of these potentially undervalued stocks, these big-name investors taking the plunge, but also the complexities of China's, regulatory and geopolitical landscape.
It's a balancing act, isn't it? Weighing those potential rewards against the inherent risks. And ultimately, the decision of whether or not to invest in China really comes down to your individual circumstances, your risk tolerance, and your investment goals.
Yeah, there's no one-size-fits-all answer here.
Yeah.
What might be a great opportunity for one investor could be a recipe for disaster for another.
Exactly. That's why we encourage you, our listener, to do your own deep dive. Don't just take our word for it.
Yeah, go beyond the headlines, read those company reports, understand their business models, familiarize yourself with the regulatory environment, keep an eye on those geopolitical developments.
And perhaps most importantly, reflect on your own financial goals. What are you hoping to achieve with your investments? What level of risk are you comfortable with?
Investing should be a thoughtful process, not just an impulsive reaction to the latest market buzz.
Well said. It's about making informed decisions that align with your own individual circumstances.
So, as we wrap up our deep dive into the potential of Chinese stocks, let's kind of distill those key takeaways for you, our listener.
All right, so first we saw how those unusual bond trends in Asia, particularly that inversion between Japanese and Chinese bond yields, could be a signal that the market is reevaluating the risk associated with China.
Except those bond yields are whispering, hey, maybe China's not as risky as everyone thinks.
Right, and some of the most successful investors in the world seem to be listening to those whispers. We talked about David Tepper and Michael Burry's, Howard Marks, George Soros. They're all putting their money into Chinese companies, betting on their long-term growth potential.
Then there's the case of those specific stocks, Alibaba and PDD Holdings. Both are operating in high-growth sectors of the Chinese economy. And some analysts are predicting some pretty impressive upsides.
But remember, investing in China isn't for the faint of heart. It requires careful consideration of that unique regulatory and geopolitical landscape, as well as a thorough understanding of each company's fundamentals.
It's like navigating a ship through uncharted waters. You need a good compass, a skilled crew, and a healthy dose of caution.
But for those who are willing to do their homework and embrace a bit of risk, the potential rewards could be significant.
So, with all these insights in mind, the question remains, do you think investing in China is a risky gamble or a hidden opportunity?
We've given you the tools and insights to start your own exploration. Now it's up to you to decide.
Thanks for joining us on this deep dive. Until next time, happy investing.